Welcome back to another episode of Investing Explained. Here's today's question. Very often when people talk about ETFs and index funds, they are using them interchangeably, but they're certainly not the same. So let's first talk about what is an ETF. So an ETF is an investment vehicle to invest in multiple securities. And a common misperception is that an ETF always tracks the performance of the stock market. And while it can certainly do that, it can also track bonds, small cap stocks, or anything you can basically think of. And I think the reason for this misconception is that the most popular ETFs track what we typically refer to as the stock market. For instance, the S&P 500 in the US or the market for all stocks in the world. Okay, so let's talk about what is an index fund. You have an index, and you also have an index fund tracking that index for nearly every financial market in existence. So in the US, the most popular index fund tracks the S&P 500, so 500 of the biggest public trading companies. But several other indexes are widely used as well. You can think of the Russell 2000, made up of small cap company stocks, or the Barclays Capital US Aggregate Bond Index. So an index is really just something that is made up that follows different criteria depending on what is of interest. Now, if you buy an index fund, you can use an ETF, but you can also track an index through a mutual fund. Now, that takes me to your second question when you ask about what is the better investment. And please don't get me wrong here, but I don't think it's the right question to ask. Rather, I would say that if you decide to invest in an index fund, you would for tax reasons prefer to invest in the index fund through an ETF rather than a mutual fund. And the difference is mainly due to legislation, where an ETF is generally a more tax-efficient way to invest since it doesn't have to pay tax on the capital gains it makes whenever it rebalances the portfolio. Another important reason is that an ETF is cheaper to operate, so the expense ratio is just lower than on a mutual fund. And since it's cheaper to operate, the investment return will also be correspondingly higher. Now, the inner mechanics are less important than understanding that generally you should favor an ETF or an index fund. And then you ask, which index fund should you buy? Okay, so the first thing to note is that you never buy the actual index, but you buy into a fund manager building a portfolio whose holdings mirror the security of a particular index. For instance, if you buy an index fund tracking the S&P 500, the fund manager will buy stocks in 500 different companies. And the performance of the fund will not just be the same as the index, but how well the manager tracks that index. Now, passive managed index funds are designed to track that index automatically. So the so-called tracking area is typically very small. In that case, it's really more a question of picking the right index rather than picking the right fund manager. Now, this is opposed to an active managed ETF that by definition is created to outperform the selected index. For instance, our friend Tobias Carlyle, who we had on the show here multiple times, he has an ETF called CIG. And he uses an active strategy on selecting stocks with the aim of outperforming the MSCI US Large Cap Index. So here you are buying the skill set of Tobias, the fund manager, rather than the benchmark index. You are required to have a benchmark index, but it's really not so important if you actively manage because by definition you want to do something that is different. Now before I hand this over to Preston, thank you so much for your question. And on top of the access to TAP Finance and the Intrinsic Value course that Preston will talk more about later as a thank you for asking the question, I also created a course about investing in ETFs that we'll make sure to give you access to, and I really hope you find relevant. That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.